Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, everybody, and welcome back for another episode of the Prosperity Holistic Wealth and Health Podcast. I have a guest that I've known for many years, and guess what? I get to work beside him every day. Chad Weigl is a financial retirement planner and a certified financial fiduciary who specializes in developing customized retirement strategies for successful professionals. As a lead advisor here at Prosperity, he's been with us for well over a decade. He brings a deep expertise in retirement income planning, tax strategies, Social Security, Medicare, and also estate planning. Chad holds a Series 65 license, life and health, along with a dual bachelor's degree in accounting and also criminal justice. So, Chad, we're here to talk about post-tax season.
Yeah.
What should we be doing to reset, and how can we do some smarter planning for our return? So glad that you're joining us again back on the podcast. I know you've been here before, but tax season is behind us. What should people be doing right now that their return is complete instead of just going, oh, I'm done with this. Let me go file it in a drawer. I'll look at it a year from now. What should we be doing?
Yeah, I mean, that's the key there. A lot of people just file that tax return away, and that's really not the right move. You really want to be taking a look at where the income that hits your return actually came from and what is triggering that income on your tax return. You want to make sure that there's not incomes that are hitting your tax return that are causing unnecessary taxation. So we'll talk a little bit more about that as we kind of roll through this. But really, that planning for this year, it should be starting. You shouldn't be hanging up that tax return and just calling it the end of the day because it's filed. You should be using it as a tool to really look at what you should be doing in the current year to really make sure you're optimizing your tax scenario.
Yeah, no, I love it. Let's dive a little bit into what you just said there. Is like on our tax return, there's things that show up that just cause tax that we don't even realize. So if I have money in a bank account, guess what? That interest from that bank account is taxable. And as interest rates have crept up over the last, 3-ish years, I know they're kind of settling in a certain area. That causes tax. And people go, oh, I didn't really, it, but you go, oh, crap, I had $10,000 worth of interest on my tax return. I didn't really plan for that. But I think one of the bigger ones that you see is the capital gain distributions from like an ETF or a mutual fund. Will you speak a little bit of that to the audience?
Yeah, a lot of times people don't realize it, but the way they have their post-tax investments invested, which could be in a mutual fund or even in the ETF, they're not paying attention that during the course of the year, right around December timeframe, there could be capital gain distributions that occur that they didn't even receive the money. And when they go to file their taxes, all of a sudden there's $20,000, $30,000, $40,000 worth of capital gains. And they're like, where the heck did this come from? So making sure that the investments, probably one of the hardest investments to manage is that post-tax money because of that. And you really should be using specialized strategies around your post-tax dollars to avoid those unforeseen capital gain distributions that really hit you at the end of the year, simply by the managers of those funds making internal trades on the stocks that are held in them.
Yeah, I mean, I think you said it best. It's like, hey, you don't even sell these funds, but somewhere between like November 15th to December 15th, the fund managers throughout the year decide to sell some stuff, and now you're getting the capital gain distribution. You didn't sell the fund, but in your non-retirement dollars, right, the post-tax money you reference, hey, guess what? This thing hits my tax return, and I go, uh-oh, that's an extra $50,000 I wasn't expecting on my tax return. That could have some tax consequences. We know it will, and there's ways to get around this and properly plan. But Chad, when you look at a tax return, I mean, you've been doing tax returns for years. You've been doing tax planning for individuals for years. Is there specific line items you look at or a section that tend to reveal like gaps or maybe a missed opportunity?
Yeah, absolutely. One probably the first one you want to look at is your adjusted gross income. And the reason why I say that is it impacts so many different areas on, in regards to tax. It drives a lot of the phase outs for, credits and deductions. It also can potentially, it does impact the potential of paying additional Medicare premium, which was really just an additional tax when you go to pay your Medicare premiums. It also impacts taxation of Social Security. So adjusted gross income is definitely something you want to be aware of. Any credits, deductions, make sure you're doing your planning around that adjusted gross income because it impacts so many different things. We had already spoken about the capital gains area. So, there are strategies to eliminate or reduce the capital gains that are being there. There's also opportunities for tax loss harvesting throughout the year on that capital gains and maybe reduce that number that hits there as well. You always want to be looking if you're retired and taking, distributions from IRAs, you want to look at that line item. Am I following a tax efficient withdrawal strategy in regards to how I'm taking my money out and where I'm taking that money from? Because there are ways to play the tax code by utilizing Roth money, post-tax dollars like those brokerage accounts and IRAs efficiently to come up with a really strong strategy. You also want to look at your Schedule A. This is a huge one, especially if you're charitable in nature. There's specialized funds out there where you can get, enormous bunch deductions if you're charitable in nature. So making sure you're actually the money that you're donating to charity, you are getting some sort of benefit on that. You could use like a donor advised fund and bunch a large contribution into a donor advised fund and then potentially take it on your tax return that year. You also want to look at your withholdings, like for W-2s, and also your estimated payments, because that's going to tell you, are you in line to kind of keep your, refund or potentially what you owe in check when you go to file that tax return. Those are probably the key areas you want to be focusing on.
Yeah, and I think one I just want to throw in there for everyone to hear, for all of our individuals prior to 65 years of age, are they eligible for an HSA where they can get an actual contribution to an HSA and it counts as deduction? And if you're a business owner, right? If you're a business owner, there's so many other deductions and so many other retirement plans that you have the ability to take advantage of to make sure you're not missing out on some of those bigger opportunities. One of the things, Chad, we saw this tax season was larger refunds, right? Because of the big, beautiful bill that took place, we had a higher standard deduction. If you're over the age of 65, you got the senior deduction added onto the standard deduction. In addition, if your income was certain levels, you might have got a $6,000 per person. So if I got a larger refund, what can I be doing differently to plan for the future, knowing that like this tax code is going to stay, a lot of these are going to stay for the next, 2 to 4 years, depending on exactly what it was. What should I do?
Yeah, really, there's a couple main areas I focus on. One, like if your emergency fund is not where you need it to be, then that is a potential where you can replenish an emergency fund. Also, if you have high interest, we know where the interest rate environment is right now. If there's credit cards out there, they've really increased the interest rates on that. Or if you have high interest debt, that's an opportunity to really take a big chunk out of that debt and also increase your cash flow by doing so because you're reducing what that monthly payment is. In regards to, saving for retirement, say that none of those apply. You have a great emergency fund. You're not carrying any debt on the books. Look at maybe now for the next couple of years, I can increase my retirement savings, whether it's through the 401k or you're using outside strategies like maybe a backdoor Roth IRA or contributing directly to a Roth IRA or even contributing into a brokerage account. You really want to be focusing on your long-term goals when you have that excess money, but you really need to sit down, review, and decide where is the best place to implement this money.
Yeah. Well, unfortunately, we have to deliver bad news from time to time, right? And that comes to the opposite side of what we're talking about. We talked about the refunds or the larger refunds. but there's those people that owe. And you and I know we tell people from time to time they owe a bunch of money. Now, these aren't particularly the clients that we help the tax management. They're usually the people that are referred to us that it's their first time getting their taxes done, and we got to get them in line. So that individual was referred to you, Chad. You met with them. You did their taxes for the first time because they're coming in for taxes instead of financial planning, but there'll be financial planning in the long run. What would you do for those individuals? What adjustments would you help them make? Let's just use the example. Give me an example of they're working or they're in retirement.
Yeah. So working, a lot of times we see this where there's a lot of tax due. And sometimes this is due to a job change, maybe inter-year, and the withholding started over from the bottom again. Or maybe there's multiple incomes hitting a return because they have multiple jobs. That will trigger to where you're owing. So really, looking at the W-4, filling out the W-4 properly for withholding purposes. If you're a self-employed individual, really looking at when does my income come into my business, from a self-employment standpoint, and making sure that I'm on track with my quarterly payments. That's how you're really going to alleviate those massive tax bills that can occur for either underpaying estimates or under withholding from, a W-2 employer, maybe not, necessarily due to you not making the right election on your W-4, but simply because you may have multiple incomes hitting or there was a job change that year, which will levelize out. So it's really looking at that and determining where that tax is coming from. Also, like for higher income earners, you want to be looking at like the bonuses when they come in. Are they withholding properly on those bonuses? Are there opportunities here for maybe deferred compensation, where you could defer some of that tax, reduce the tax burden, increasing potentially retirement contribution levels? And obviously, we talked about capital gains, ordinary interest. Those things hit the return and there's no tax withholding on it. So making sure you're doing optimal things to control the tax that comes from those capital gains, as well as dividends and interest that hit your tax return.
Got it. Yeah. You have so many years of experience. And one of the things I've seen you do and help individuals with is tax efficient withdrawal strategies. So what are some of those strategic decisions you're making for people? Let's say I'm going to retire in June of this year, and I go from working my whole life, and all of a sudden I am now retired at the end of June. What is kind of the things you're doing for those individuals? What are you putting in place?
Yeah, so we're really looking at, prior to that retirement, we've obviously had a discussion around income planning and what the income need is in retirement. So we have a good idea of what the budgeted income is for the year. And from there, we're looking at when you have that retirement intra-year, you still have those W-2 wages. You want to see where they're going to be lying when the W-2 wages are completely out of the picture, what types of assets they have accumulated, whether it be the pre-tax mostly, if they have post-tax, or if they have Roth, and really looking at those various, because those are all taxed differently. Not all money is taxed the same. That is an important thought to bring up, is what can we do to structure it to keep them in the lowest possible bracket possible, but also making sure we're maximizing the different accounts that they've saved for.
Yeah. So it's a lot of just, you shared it. You've already had the conversation with them. You've already talked to them years prior of what this actual retirement will look like. When I call that hybrid year, hey, maybe you worked a few months into the year, then the rest of the year you're retired, then going forward you're retired. What are we doing and purposely setting up their assets to make sure they're using those different types of money? You share with us not all money's taxed the same, which is a great thing to say. It's structuring that pre-tax income versus that post-tax income and some of that tax advantage, that Roth money. How can we make that little bit come from each, assuming we have all of those, and make sure we're paying the least amount of taxes, excuse me. And one of the things, if you're in a 12% tax bracket or a 22% tax bracket, share with me the thought of like, don't leave money on the table. And should we be maxing out that bracket to make sure we're taking advantage of different things.
Yeah, and having an understanding of where you are from your tax bracket standpoint is critical to planning, because every year it's very rare that someone's going to fall at the very top of their bracket. There are some pitfalls that you have to be aware of, because there's some additional potential Medicare tax on Part B at the top of the 22, so you have to be cognizant of that. But really looking at, if I had mostly pre-tax dollars as an example, and, in retirement, that's where a large majority of my money's coming from on top of the Social Security. You really want to look at, one, how is that Social Security going to be impacted coming into the tax picture? Two, on the IRA distributions, if I'm falling middle of the 22% bracket on my IRA distributions that I need to produce my income, why would you not, on any additional dollar you take out of those IRAs, you're going to be taxed at 22. In today's tax rates, which are, in my opinion, probably some of the lowest rates we're going to see, it only makes sense to bring that, to go up towards that top of that bracket and incur that either through a Roth conversion, which is getting that additional, type of money out there, that tax-free dollars, to incur that money and purposefully incur that tax, knowing fully well if I take another dollar out of my IRA, it's going to get taxed at that anyway. And then there's the other factors that come into that, such as if it's a married couple and a surviving spouse scenario, they could end up in higher tax brackets, or maybe the kids are high income earners, and if they inherited the money, they could be paying way more in tax than you would be. So clearing that tax liability, buying out that partner that is the federal government out of those dollars, if there's room in those brackets, you really should be looking at doing some tax planning around that.
Can you explain to us how that coincides with maybe a Roth conversion strategy? We're outside of tax season. How do you explain Roth conversion strategies? Is there a certain time in the stock market that we should be converting to a Roth? Give us a little context there.
Yeah. So, I mean, with our clients, when we're doing tax planning, we have a general idea once they're in retirement of where they're going to be falling every year as far as what they need in income and how much room we have, that generally to do in a Roth conversion. So to your point, like intra-year, I'll give a great example. Like last year, what happened? There was tariffs that were assessed, right around April timeframe. And what happened to the stock market? The stock market pulled back significantly. So from that standpoint, that's an opportunity. I don't look at that as a negative, seeing the stock market pull back. I look at it as a positive, because guess what? A lot of our clients are falling in those middle brackets, and we're doing those Roth conversions for them. And that is an opportunity to be getting more shares over at a discount. And when those shares recover, they're going to recover tax-free. So tax planning is not always just in December, November timeframe towards the end of the year. You want to be looking at what's going on in the markets throughout the year to make sure you're making the right decision and doing the most tax efficient decision in regards to your Roth conversions.
Yeah, no, I love it. It's, if there's an opportunity, you want to take advantage of it. And anytime the market goes down, that is an opportunity to take advantage of some stuff. We talked about that Roth conversion, like April of 2025 when the market was down. But some of the other things that we also implemented for people on those non-retirement dollars, those post-tax dollars, bond funds might have been down during that time, or one of the stock funds that you own was down. Hey, could we have sold it, which we did for many people, and then exchange it for another fund that has similar investments to it? Or what that would have done, it was tax loss harvesting. It created losses on the tax return that can go against some of those future capital gains we had talked about before. Mm-hmm. We talked about the investment strategies that can help eliminate or greatly reduce some of those capital gains. But we can also do some strategies when the market is down, to your point with Roth conversions, but also on the other type of money, that post-tax money that we could be taking advantage of.
Correct.
So you work with a lot of high-income individuals. How do you translate last year's tax outcome into a concrete, forward-looking tax strategy maybe we need to think over the next 12 months or before year's end?
Yeah, I mean, with working with higher income earners, there's generally a lot more variables you're having to deal with because of just how they're generally compensated. So you're going to be, if they receive equity compensation, those kind of things, you want to have conversations around like what is the projection of potentially the stock you might be receiving, do an analysis on what that's going to do in regards to, the tax scenario. Are there opportunities for deferred compensation where they could defer some of their income based on what their compensation plan looks like? So it's a lot of reviewing of what is going to go on next year based on your compensation plan, and making sure that we're making proactive decisions around that. A lot of those decisions need to be made the year before. Like those aren't decisions you can make in this year, meaning a lot of deferred comp, that's all being done November, December timeframe of the prior year. So as we've met with these higher net worth and clients, we understand the compensation plan. During the election period, when we're making those elections, we have a good idea of what the income is so that we can really help to control, especially those higher brackets, fully well knowing that down the road, they're more likely than not potentially going to be in a lower bracket. So making those adjustments, making those deferrals to put them in a better place. Obviously, in regards to post-tax dollars, those kind of things, we want to be actively managing those strategies from a tax efficient standpoint. So whether that's using stock managed accounts or tax managed post-tax accounts, we want to be looking at harvesting, those gains and losses during the year to mitigate capital gains that are out there. You obviously, if they're charitable nature, want to be looking at the various gifting strategies that are available to them. And making sure that, they're bunching and getting their dollars, getting the value on their tax return for doing those donations to things that are near and dear to them. So also looking at making sure that the business is structured appropriately. If they're self-employed, they're in the right type of entity structure, making sure they have the proper retirement plans built into that entity structure. So there's a ton that goes into, higher net worth, whether they're self-employed or if they're highly compensated, executives that are receiving stock, those kind of things. You really need to understand the ins and outs of their overall compensation.
Yeah, no, I love it. And some of these people with their compensation, they have restricted stock units, stock awards, and sometimes you're forced to sell those during the year or forced to vest during the year. And that hits part of their compensation structure. So understanding how all of that fully aligns with individuals, and a lot of the clients that we have at some of the larger tech companies in the United States have a lot of those RSU structure, or pharmaceutical companies. A lot of those run into those different, how they're compensated is different than just a salary and a bonus there. But last thing, Chad, if there was one thing you want to share with the world about taxes, what would it be?
Pay the least possible you can.
Well,
legally, least possible you can legally.
Hey, there you go. Legally, that's the big thing. Is none of us want to be in an orange jumpsuit anytime soon. So greatly appreciate you coming on again, and I'm sure we'll see you here in the future sometime. Thanks, Chad.
Thank you very much.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family.